Hello and welcome to The Trade. Before we get to the charts that matter, let's have a quick look at what traders are watching out there. US President-elect Donald Trump picking former Director of National Intelligence John Ratcliffe to serve as Director of the Central Intelligence Agency. Ratcliffe, a close ally of Trump, served as Director of National Intelligence at the end of his first term. Meanwhile, investors have sobered up from post-election euphoria over Trump's victory and taken some profits ahead of the key CPI report coming through tonight. And of course, that kicks off a calendar thick with US news events that markets are going to be watching for the rest of the week. The US oil and gas industry has called on President-elect Trump to scrap many of President Joe Biden's policies aimed at fighting climate change, saying the measures threaten jobs, consumer choice and energy security. And oil and gas major Shell has won an appeal against a landmark ruling that required it to accelerate carbon reduction efforts, dealing a blow to campaigners who've turned to legal challenges to pursue climate action. Let's get now into the technicals and the charts that matter. Tony Sycamore from IG joining me. So a little bit of a rebound or unwind, I guess, of the Trump trade, but the Nasdaq only off by about 0.1%.
That's right, just a gentle retreat if you like. I mean, if we look back to this time last week, the Nasdaq has made some considerable gains, as all the stock indices have. And I think what we're now mindful of is that we're going to see a CPI number which potentially has some upside risks for the market. And why that is important is we are seeing a repricing in the interest rate market. We have 10-year yields resuming their march higher overnight. We know that some of the policies which Trump is indicating he will implement, be it tariffs, be it tax cuts, are inflationary. 10-year yields are now up against a very important layer of resistance at just around 4.5%. Now, if that level breaks because of a hot inflation number, we could see US 10-year yields springboard higher up to 4.75%. And that's something which would weigh on equity. So right here, right now, it makes sense to take a little bit of profit off the table. As you can see on that chart there, the Nasdaq has been following a very nice trend channel higher, been respecting the support provided by the 200-day moving average, which is the orange line there. I don't see I guess the loss of momentum we saw overnight as anything sinister. I think it's been a bit of a consolidation that we're going to start to see, and then we see what this CPI looks like tonight. Because if it is a little bit hotter, it does bring into question the probability of a follow-up rate cut by the Fed in December.
Just getting some news on the wage price index as well, up 0.8% quarter on quarter, 3.5% year on year. So a little bit lower than what the market was looking for. But today we are seeing a retreat on our equity market, really, as we start to see some of this euphoria unwind.
Well, a nice print from the wages, and it continues to moderate, which is what the RBA want to see there, and probably a precursor to a potential RBA rate cut at some point next year. But the driving force in the ASX 200 has just been disappointment around China. The stimulus package announced on Friday didn't have the details which we wanted to see around demand and consumers. And we also had very soft inflation data. So there is concerns that the Chinese deflationary spiral still exerts a force on China. And I think why that's important is it just is really flowing through into our big resource stocks through the price of commodities, which is also being impacted by Trump as well. So commodity prices are being impacted by a higher US dollar. So all in all, that's not a great picture for the ASX 200 at the moment. It is some strong headwinds. And really what we look at in the ASX 200, it is just trading sideways. It hasn't been able to get above that trend channel resistance. Now sits around 83.60 to 83.80ish. And on the downside, it really hasn't spent a lot of time below 8100. It did have a brief look 2 Fridays ago, but only a very brief look. But we really need to see the ASX 200 break those extremes, 83.80 on the top side or below 8100, to really give us a good indication on what comes next for the ASX 200.
Indeed. Now, we're also looking very closely at what's been happening with currency markets. We did just talk about the wage price index, so it'd be interesting to see what the dollar is doing at the moment. But more broadly, it does look like the greenback strength is punishing our currency.
It really is. And I mean, there's just this point of view that we went into the US election with the dollar on quite firm. It had that little bit of a head fake on the Monday and the Tuesday before the election because the latest polls suggest it was a lot closer. But what it did do is it cleaned up a lot of positioning, and really there wasn't a great high conviction in many of these trades because the election was supposed to be so close. As it turned out, the US dollar has absolutely continued to run higher. And now we think about what that means. Well, yes, there's a bit of a void between now and the inauguration on January 20th when we find out potentially, when Trump's, becomes the president, and then his tariffs and potentially his tax cuts, we find the sequence or the order of what way he's going to do that. But so there's a little bit of, I guess, time to go between now and then, and that allows that US dollar to run higher. But the other thing is when we go into an election or a big event where positioning isn't heavily stacked, it's not just a 1 week event whereby we can think we can get all the traders in the world can get long the US dollar. There's a lot further that this trade could run in the interim to January 20th. So yeah, I think the Aussie dollar is vulnerable. It's trading now at 65.23. We've got some support down there around 65.10ish. I think that level's going to go in due course, and we probably see it trade down towards 64 cents. So very much we're on the back foot, and I think that continues.
Yeah, look at that big drop we saw when the wage price index came through. And for those just joining us, I will reiterate, as we talked about, coming lower, which is what the RBA wants. So 0.8 of 1% quarter on quarter. Reuters was looking for a 0.9% gain and 3.5% year on year. So below expectations of 3.6%. As you say, Tony, heading in the right direction, which is lower. Let's talk about gold, also lower, 2-month low.
Yeah, that's the function of higher US dollars and higher yields. It's just undermining that demand for the gold. Gold had a fantastic run, and it looks like it's broken some very significant levels there. Breaking below 2,600 overnight. So we're now seeing probably, I think, more unwind of this long positioning, which built up during this very nice run higher. I don't think we've seen the last of this position wash. I think there's probably some further downside risks. 2550 and potentially 2500. The market did go into this election. We had this, I think we chatted for a couple of weeks talking about the uncertainty ahead of the election and gold being a very, very good hedge. Well, that hedge is now being removed because we know who's won. We know it's probably going to be a red sweep. And we also know that yields in the US dollar seem to be continuing on that upward, unrelenting march higher.
And finally, Bitcoin. I mean, heading to the moon, one of my guests told me, it potentially could be 100,000 by the time Trump takes office.
Well, I mean, I've been thinking 80,000 pre the election. It got to 80,000, gone to 90,000. And now, I mean, you look at that chart, it's parabolic, so you don't want to be arguing in terms of where we're going to see a top. But what I will say is it's moved 30% higher since this time last week. So it's priced in some good news, probably needs to have a little bit of a break, a little bit of a pause. And what I think starts to happen is we start to see some rotation into the altcoins. So Ethereum, for example, is still trading 20% below its year-to-date high. So it's not unusual to see Bitcoin lead the charge and then some of the alts start to play some catch-up. So I'm not saying we're here right now, but I think we're very, very close to Bitcoin, probably starting to consolidate ahead of that 100,000 level, and then some of the altcoins start to come back into favour.
All right, Tony, always good to chat. Thank you so much. Tony Sycamore there from IG. That does it for this edition of The Trade. Be sure to join us again next time.